All right, so you wanted to get a handle on this whole margin of safety thing in investing, and you sent over some Benjamin Graham,
Yeah,
the OG himself. We're
absolutely.
talking the intelligent investor,
Yep,
which is like the value investing starter pack even decades later.
for sure.
Smart move.
Couldn't agree more. Graham is practically the patron saint of value investing, and this idea of margin of safety is his masterpiece.
Oh, yeah.
Even Warren Buffett's a huge fan, and that guy knows a thing or two about making money, right?
Just a little bit.
Yeah.
But instead of just name dropping, let's actually unpack what Graham's talking about. We're going to deep dive into margin of safety.
All right.
What it is,
Yeah.
why it's so important, and how it applies to everything from bonds to stocks.
Let's do it.
You ready for this?
You know, Graham starts this chapter with a quote that really stuck with me.
Okay.
This too will pass.
Hmm.
It sounds almost philosophical,
Yeah.
but it gets right to the heart of why margin of safety is so crucial.
Okay. I'm intrigued how so.
Think about it.
Yeah.
Markets are unpredictable.
Right.
What's hot today could be a dumpster fire tomorrow.
Oh, for sure.
But that quote,
Yeah.
this too will pass, reminds us that no matter how bad things seem, they'll eventually get better.
Right.
And on the flip side, those amazing bull runs,
Yeah.
those won't last forever either.
Right.
Margin of safety helps you ride out both those extremes.
So it's about being prepared for anything, basically.
Exactly. It's the financial equivalent of wearing a seatbelt.
Okay.
You might not need it every time you drive,
Right.
but when you do, you're really grateful you have it.
All right. I'm getting the why,
Okay.
but I still need the what.
Sure.
How would you explain margin of safety to someone who's, let's say, never even bought a stock before?
I tell them, it's like buying a house, right?
Okay.
You wouldn't just offer the asking price without an inspection, would you?
No.
There could be hidden problems,
Uh-huh.
a leaky roof, bad wiring, who knows?
Right.
You'd want a discount to make up for those potential issues.
Yeah.
Margin of safety is that same discount, but for investments?
So you're saying I should never pay full price for a stock?
Not quite. It's not about being cheap. It's about understanding value.
Okay.
Margin of safety is the difference between the price you pay
Uh-huh.
and what that investment is really worth.
Yeah.
It's intrinsic value.
Right.
And you want that difference to be as big as possible to give you that cushion.
Okay, so how do you figure out that intrinsic value thing? Is there some secret formula?
No magic formula,
Okay.
but there's definitely a process.
Okay.
Graham starts by looking at bonds.
Okay.
He uses this example of a railroad needing to earn 5 times its fixed charges.
Okay.
Things like interest payments, taxes, that sort of stuff,
Uh-huh.
before even thinking about paying dividends or anything else.
So the railroad needs to be making bank before it can even think about rewarding its investors.
Exactly.
Wow.
And that 5 times earnings?
Yeah.
That's the margin of safety. If the railroad's income suddenly drops, which can totally happen,
Right.
there's still a buffer before the company starts struggling to pay its debts.
I see.
The bigger that margin, the less you need a crystal ball to predict the future perfectly.
That makes sense, but I feel like bonds are generally considered safer than stocks, right?
Hmm.
How does this margin of safety idea apply when you're buying a piece of a company, not just lending it money?
Great question.
Yeah.
With stocks, Graham says margin of safety comes from buying them significantly below their earning power.
Okay.
He uses this example of a company earning 9% on the price you paid,
Okay.
while bonds at the time were yielding a measly 4%.
Gotcha.
That 5% difference is your margin of safety. You're
Mhm.
getting a better return for the risk you're taking.
So I should always compare stock returns to bond yields.
Not exactly. It's about understanding the relative value.
Okay.
Graham wrote that example back in 1972, and even he was worried that the margin of safety for stocks was shrinking.
Oh, wow.
Things change. But the point is, the price you pay always matters.
Okay.
A great company can be a terrible investment if you buy it at an inflated price.
So it's not just about finding good companies, it's about finding them at a good price.
You got it.
Yep.
And that brings us to one of Graham's biggest pet peeves,
What's that?
what he calls fair weather investing.
Oh, no.
He saw a lot of investors lose their shirts buying mediocre companies just because times were good,
Oh, yeah.
thinking the good times would last forever.
Oh, so like those people who bought up houses right before the housing bubble burst?
Exactly.
Yeah.
Graham actually uses this example of real estate bonds from the 1920s and 30s.
Okay.
These bonds were considered super safe
Yep.
and sold at face value, what's called par.
Mm-hmm.
But underneath it all, there was very little real value to back them up.
So they looked safe, but they were actually ticking time bombs.
Pretty much.
Yikes.
When the Great Depression hit, those bonds tanked.
Oh, man.
Prices collapsed.
Oh, no.
And tons of people got wiped out. But here's the twist.
Okay.
At those drastically lower prices, some of those bonds actually became great buys.
Wait, so the same asset that was a terrible investment at one price
Yeah.
becomes a good one at a lower price?
Yep.
That seems kind of counterintuitive.
It all comes back to margin of safety. At the lower price, there was finally a big enough gap between the price and the underlying value.
Okay.
That's Graham's point. There's no such thing as a universally good or bad investment. It all depends on the price.
Mind blown.
Hmm.
I think we need to pause for a second and let our listener absorb that.
Take your time. This is the kind of stuff that can really change how you think about investing. So you ready to put this margin of safety thing into action?
Yeah, let's do it.
Let's talk about how it helps you build a portfolio that can weather any storm.
Because let's be real, investing can feel like navigating a hurricane sometimes.
Oh, yeah.
One minute you're riding high, the next you're clinging to the mast for dear life.
That's a perfect analogy.
Yeah.
And margin of safety is your life vest. It helps you stay afloat even when the market throws its worst at you.
All right, I'm strapped in and ready for the choppy waters.
Okay.
What's the first step?
First, remember that margin of safety really shines when you're hunting for bargains.
Okay.
Those undervalued gems that the market has overlooked.
Sounds like treasure hunting.
It is.
So we're talking about those companies whose stock price is way lower than its intrinsic value, right? That big discount we talked about earlier.
You got it.
Okay.
And that's where your research skills come in.
All right.
You need to dig deep, understand the business, and figure out if the market's pessimism is justified or if it's just a temporary blip.
Okay, so let's say I found a few of these bargain stocks. Yeah. I'm feeling pretty good about my analysis.
Okay.
But there's still that nagging voice in my head. What if I'm wrong?
That's where diversification comes in.
Okay.
It's like that old saying, don't put all your eggs in one basket.
Right.
Even with a solid margin of safety, any single investment can go south.
Yeah, that's true.
Things happen. Industries, change management makes mistakes. Black swan events pop up out of nowhere.
But wait, isn't diversification just admitting that you can't pick winners?
Hmm.
How does that fit with all this emphasis on thorough analysis?
It's not about giving up on analysis. It's about being realistic.
Well,
Even the best investors get things wrong sometimes.
yeah, that's true.
Diversification helps you manage that risk.
I see.
Think of it like this. Even if you had a slight edge in roulette, betting all your money on a single number would be insane, right?
Yeah, that's a quick way to go, bro.
Exactly.
For sure.
But if you spread your bets across multiple numbers, your chances of winning something go up.
Right.
Diversification does the same thing for your portfolio.
Right.
It increases the odds that your winners will more than offset your losers.
So diversification is like an insurance policy against being wrong.
Exactly.
I can get behind that.
Good.
But I feel like we need to address the elephant in the room.
Oh, yeah.
The whole idea of speculating versus invest. Graham seems to think they're totally different beasts, right?
He does. For Graham, a true investment has that solid margin of safety built in.
Yeah.
It's backed up by numbers logic and real-world experience.
Okay.
You're buying a piece of a business because you believe in its long-term value,
Right.
not because you think the stock price is going to spike next week.
So it's not about trying to time the market or get lucky with a hot stock tip?
Nope. Speculation is all about gambling on those short-term price movements,
Okay.
often based on rumors, hype, or just plain gut feeling.
Uh-huh.
There's no real analysis, no margin of safety.
Right.
It's basically playing the stock market lottery.
Hmm.
And most people lose that game.
So with investing, you're buying a company,
Yeah.
but with speculating, you're buying a story.
That's a great way to put it.
Yeah.
And stories can be very seductive,
Yeah.
but they don't always have a happy ending.
Okay. I'm definitely starting to see the difference.
Good.
But there are times when even boring investments can get exciting, right? Like when everyone's talking about a particular sector or trend, and it seems like every stock in that space is going up.
Oh, yeah. Those are the times when it's hardest to stay disciplined.
Yeah, for sure.
But that's also when margin of safety becomes your superpower.
Okay, how so?
Remember, the price you pay always matters.
Right.
Just because everyone's piling into a certain type of stock doesn't mean it's actually worth the price they're paying.
So even in a hot market, I should still be looking for that discount, that margin of safety.
Absolutely don't get swept up in the mania.
Okay.
It's like that saying, if you're at the poker table and you don't know who the sucker is, it's probably you.
Ouch, I don't want to be the sucker.
Nobody does. And that's why Graham spent so much time talking about the psychology of investing.
Mm-hmm.
He knew that our emotions, fear and greed especially,
Yeah.
can lead us to make terrible decisions.
So how do we avoid those emotional traps?
It all comes back to having that solid investment philosophy we talked about earlier. You need to know your goals, your risk tolerance, and your time horizon. And you need to stick to your plan even when the market is trying to tempt you with those shiny, risky bets.
So margin of safety isn't just a number.
Yeah,
It's a mindset.
exactly. It's a way of thinking about risk, about value, and about making decisions that align with your long-term goals.
Okay. I'm starting to feel like I can actually apply this stuff.
Got it.
But I got to ask, what about those unconventional investments Graham talks about?
Okay.
Things like distressed companies
Yeah.
or those weird financial instruments that most people don't even understand.
Right.
Aren't those super risky?
They can be, but remember, Graham was all about finding value where others saw only danger.
Okay.
He believed that even seemingly risky assets could become sound investments if you bought them at a low enough price.
I see.
That's where the margin of safety becomes even more crucial.
So it's about finding those diamonds in the rough, those hidden gems that the market has mispriced.
Exactly, but it's not for the faint of heart. You need a strong stomach, a deep understanding of the specific situation, and a willingness to do your homework.
So it's like those extreme couponers who spend hours researching deals and comparing prices to save a few bucks on groceries.
Yeah.
Except with investing, the stakes are a little higher.
That's a great way to put it. It takes a certain type of personality.
Yeah.
Someone who enjoys the thrill of the hunt, the challenge of finding those hidden opportunities.
So for most regular investors, sticking to those conventional investments is probably a safer bet.
It's definitely a good place to start building a solid foundation with things like index funds, high-quality stocks, and maybe some bonds is a smart move.
Okay.
But as you get more comfortable, as you develop your skills and your confidence,
Yeah.
you might want to explore some of those more unconventional options.
So it's like leveling up in a video game.
Exactly.
Start with the basic quests, then move on to the harder stuff once you've gained some experience.
That's the idea, but just like in a video game, always be mindful of your resources, your risk tolerance, and your overall goals.
Okay, this has been super helpful. I feel like I'm finally starting to understand how to actually apply this margin of safety concept.
Good.
But I have a feeling you've got even more wisdom to share.
Oh, we can definitely keep going.
What else should our listener keep in mind as they embark on their investing journey? Okay, so we've covered a ton of ground on margin of safety,
Yeah,
how it works, why it matters, even how to apply it to different types of investment.
we have.
But I got to ask, all this stuff comes from a book that was written back when our parents were probably in diapers.
Right.
Does this stuff even apply in today's crazy market?
You know, it's funny you should mention that because as I was rereading this chapter, that's exactly what struck me. The
Yeah.
world's a totally different place now.
Oh, yeah.
We've got all these newfangled financial instruments information flying at us at warp speed.
Right.
It's enough to make your head spin.
Seriously. I feel like I need a degree in astrophysics just to understand my 401k statement sometimes. It's crazy.
But here's the thing.
Okay.
While the tools and the players have changed,
Yeah.
the underlying game is still the same. Human nature hasn't evolved that much.
Right.
We're still driven by fear and greed.
Yeah.
We still make emotional decisions.
Yeah.
And the market still reflects all that messy humanness.
So even with all the fancy algorithms and high-frequency trading, it still comes down to psychology.
Absolutely. That's why Graham's emphasis on understanding market cycles is so relevant.
Oh, okay.
Even today.
Yeah.
He knew that markets go through periods of euphoria and panic,
Right.
and that prices can get totally detached from reality.
So it's not just about finding good companies. It's about knowing when to buy and sell. Like recognizing when the market's gone a little bit bonkers.
Exactly. And that's where margin of safety really becomes your best friend. It gives you the confidence to buy when everyone else is panicking
Okay.
and sell when everyone else is getting greedy.
Right.
It helps you stay grounded when the market's losing its mind.
Okay, so that's the why, the timeless principles.
Right.
But what about the how?
Okay.
How do you actually apply these ideas when the investment landscape is constantly changing
Yeah.
with all these new options and technologies popping up?
Well, for starters, you've got to acknowledge that the menu has gotten a lot bigger since Graham's day.
Oh, yeah, for sure.
Back then, it was mostly stocks and bonds.
Right.
Now you've got exchange-traded funds, index funds, real estate investment trusts. all kinds of alternative investments.
Oh,
It's like walking into a giant buffet with cuisines from around the world.
I'm already feeling overwhelmed. Where do you even start?
It can be a lot, especially for new investors.
Yeah.
That's why it's more important than ever to have that clear investment philosophy we talked about earlier.
Okay.
What are your goals?
Right.
What's your risk tolerance?
Right.
What kind of investment strategy makes you feel comfortable, aligns with your values?
Uh-huh.
Once you've got that figured out, the choices become a lot less daunting.
So it's like having a map before you set off into the jungle.
Yeah.
You might not know every twist and turn, but at least you have a general direction.
Exactly. And speaking of navigating the jungle,
Okay.
another huge difference today is the speed of information.
Oh, yeah.
Back in Graham's day, news traveled slow.
Right.
You'd wait for the newspaper, read your quarterly reports, chat with your broker.
Yeah, it's like, bam, news analysis, rumors all hitting you from every direction 24/7.
Totally.
Yeah, it's information overload.
And that can be both a blessing and a curse.
Okay.
On the one hand, you can react to opportunities much faster.
Yeah.
But on the other hand, it's easy to get caught up in the noise.
Right.
Make impulsive decisions based on headlines
Oh,
or what some random influencer is saying.
I've been there.
So how do you cut through all the clutter?
Yeah, that's the question.
Again, it comes back to that solid investment philosophy.
Right.
You need a filter.
Right.
You need to be able to distinguish between noise and signal.
Uh-huh.
Focus on the fundamentals.
Yeah.
And not get distracted by the daily drama of the market.
So all this change actually makes Graham's ideas more important, not less.
That's my take. The world has changed, but human nature hasn't.
Right.
And the principles of value investing are timeless because they're rooted in that understanding
Okay.
of how we think, how we behave, and how we make decisions, especially when money's on the line.
Wow, we've covered so much in this deep dive.
I know we have.
From bonds to stocks, from market cycles to human psychology.
It's been a lot.
We've really explored the ins and outs of margin of safety.
Yeah, it's been a journey.
Definitely. And to our listener, I hope this has given you a solid foundation
For sure.
in how to think about risk value.
Yep.
And building a portfolio that can stand the test of time.
Couldn't have said it better myself.
And as Graham so wisely said,
Okay.
investment is most intelligent when it is most business-like. Treat your investments like a business. Do your homework, understand the risks, and always, always demand a margin of safety.
Before you hit that buy button,
Yeah.
ask yourself, where's my margin of safety if you can't answer that clearly? It might be time to walk away or dig a little deeper.
That's some sage advice from the father of value investing himself. Thanks for joining us on this deep dive into the world of margin of safety.
Until next time, happy investing,